To the Real Estate Show with Pat Lopez, where we talk everything of real estate. For this show, I'm going to look at my predictions for 2024, how they panned out, and also what I think 2025, what it's going to look like. So let's jump right into 2024. First thing we're going to talk about is interest rates. I thought interest rates were going to hover in between 6.25% to 7.25%. Interest rates actually range from 6% to 7.5% for 2024. So I was a little off, but not that far off. And the average interest rate for 2024 was 6.75%. Now, let's look at the numbers of existing home sales nationwide. So I thought sales were going to be somewhere around 4.2 to 4.3 million. Once again, existing home sales, not new construction, is being counted in this number. Now, what ended up happening in 2024? Well, those numbers came in between 3.9 to 4 million. So a little bit softer than what I anticipated. I thought we were going to be a little bit better as far as home sales in 2024. Now, appreciation, home appreciation. I thought it was going to be maybe flat to maybe, 1-2%. And appreciation was higher than that. Appreciation was 4%. So anybody who thought there was going to be a major housing correction, that did not pan out. Appreciation, 4% nationwide. And once again, I thought it was going to be somewhere flat to, maybe 1 or 2%. Now, what do I think is going to happen and why for 2025? Now, as far as interest rates, I think interest rates are going to be pretty much the same, 6.25% to 7.25%. Now, why am I saying that? Well, there's some reasons why. Number one, the Fed. We're supposed to cut rates 4 times in 2025, and now they've been talking, saying that they're only going to cut rates twice in 2025. And what held interest rates higher in 2024 was the Fed was supposed to cut rates 6 times. They ended up cutting rates 3 times. 1 was a half, so let's just call it 4 times, cutting rates. So they weren't as aggressive. So now, why? What is going on in the market holding up these interest rates from coming down a little bit? And the number one thing is the job numbers, okay? Unemployment rate is still pretty low, and the economy and jobs are strong. Now, remember, the Fed has a dual mandate. They're working on keeping inflation low and keeping employment high. Okay, so, and they've also talked about how the most important number, because they believe inflation is somewhat under control, not at that 2% target rate yet. They're at, 2.8, 2.9, but they believe that, the market or the economy is drifting down, the inflation is drifting down closer to that 2%. So they feel they have that under control. But the employment numbers are still strong. Now, nobody wants, people to lose their job, but those employment numbers are still strong. So that is holding and propping. Now, if we see unemployment numbers start hitting, 4.3, 4.4, 4.5 unemployment rates, then the Fed will cut a little bit more, be a little bit more aggressive, and interest rates will start dropping. Now, the third thing is debt. The government spends money unbelievably. Nobody runs their household the way the government does. And there's $2 trillion worth of debt that has to be eaten up. So that means the government's going to be sending, selling these treasuries, whether it be 2, 5, 10-year treasuries, $2 trillion. So there's going to be a ton of treasuries that need to be absorbed by the marketplace. And that's in direct competition with the mortgage-backed securities, because mortgage-backed securities is a mortgage bond. So when you buy a 30-year fixed loan, it turns into a mortgage bond, okay? And they have to compete. Now, who are the people out there buying? The big institutions, whether it be a 401k, insurance companies, foreign countries, they turn around and they buy these mortgage-backed securities and these treasuries. So there's going to be a lot that needs to be absorbed. So for those reasons, I think interest rates are going to stay, a little bit elevated. Who knows what's going to happen? Once again, this is my predictions. Once again, in between 6.25 to 7.25. I think interest rates are going to be running. And right now, interest rates ended up, they're around that 7% number. So we're on the higher end. So hopefully rates will start trending down a little bit. Now, existing home sales. I think we're going to have 4.1 to 4.2 million sales. Now, why do I say that? Well, I think there's pent up demand. Life happens. People keep on getting married. They keep on having babies. The population has grown. So there is that's pent up demand. People need to buy houses. They need to live somewhere. So I think that's going to be one thing. Inventory is a little bit stronger or better. There's more houses for sale. Now, I do understand real estate is local. So it depends on, where your market is. You could still be super tight. So if you're in the northeast, inventory levels are tight. If you're down south, well, inventory levels are a little bit better. And a matter of fact, for the inventory gains that we've had in between Florida and Texas, they represent 40% of all that inventory gain. So once again, real estate's local. It depends on where you're looking, but I do think ultimately that inventory is a little bit better. People can only put off for so long in buying a house. So I think our sales will increase a little bit over 2024. And home appreciation. What am I thinking for home appreciation? Well, I think home appreciation, we're going to be anywhere between 1 to 3%, somewhere like that. And why am I saying home appreciation? Well, for the same reasons why I think there's going to be more sales. There is that demand. And ultimately, you can't get away from the law of supply and demand. And the fact that there are people out there wanting to buy homes and needing to buy homes, that demand is still going to make it a seller's market. It's not going to be as great of a seller's market, but I think it still will be a seller's market, and there will be, that demand out there. Now, I don't think appreciation is going to be super high, 5, 6, 10%, crazy numbers like we've had in the past. And the reason why is affordability. People still need to be able to afford to buy a house. And we've had amazing appreciation over the past 4 years. I mean, depending on where you're at, you could have had appreciation of 25% up to 100%. So if you had a house for $200,000, that house could be worth $300,000, $400,000 today, if you bought it, 4 or 5 years ago. So appreciation is huge. And the reality is you have to be able to afford a house. And I think we're starting to get to that point where, average Joe is having trouble affording, especially those first-time home buyers who are really having trouble. Hey, if I'm selling a house and I'm getting $200,000 of equity, I may be buying a house cash, so there's not that issue. But for those first-time home buyers, affordability is an issue. So that's why I think the appreciation won't go up, dramatically. And once again, the last reason, inventory. The inventory is a little bit better. There's a little bit more inventory out there, more homes for sale out there. And the combination of all that, I think, is going to hold back appreciation. Don't think it's going to be negative. In certain parts of the country, absolutely, there could be negative. But as a whole, no. Appreciation will average, in my opinion, anywhere between 1, 2, 3%. Well, those are my predictions. Tell me what you think. If my predictions are on or off, leave a comment. Always want to hear from you. Also, be sure to follow this show on Facebook, Instagram, and subscribe. It really helps out the show. Please subscribe. Do some likes as well. Once again, really helps out the show. Remember, this show is everything real estate, no limits. Hope you enjoyed this show. I will see you next week.